How are fees determined for asset-based financing? When calculating the costs that a client business has to pay for financing services, one must take note that rates differ from one financing company to another. Researching and getting a quote from different financing companies will help the business choose the factor that is most favorable in terms of quality of service and affordability of rates. However, although rates offered vary, there is one thing in common to those that offer asset-based financing services. Factors adjust and abase their rates according to the creditworthiness of the client's customers. Although factors also look at the client's profile, this is not the primary basis. From this, one can see the advantage of asset-based financing over securing a bank loan. Banks are very particular with the client's business itself, while financing is concerned with the client company's circumstances and the level of creditworthiness of its customers or debtors. Primarily, any factor looks for three things when considering whether it should take on that new client. One is the creditworthiness of customers. The second thing is the spread of risk of those customers. By this we mean that even though a particular customer may be strong, like Walmart for instance, the factor may refuse to factor those invoices if they are the only invoices available. The reason is that if Walmart does not pay, the factor will have insufficient protection for the 20% reserve being held back, and Walmart may not pay because the goods may have been delivered late or incorrectly packed. 3. All customers should be company customers, not individual consumers, paying as shown on invoices up to a maximum of 60 days with 90 days actual maximum payment times. Other ways to determine the costs include the kind of pricing that the factor company will employ with regard to the financing fee or discount rate. This may either be flat rate pricing, where the financing fee or discount rate will be fixed regardless of the length of time that invoices are outstanding, block time pricing, where rates are proportional to set block periods, and the pricing that is proportional to each day of outstanding invoice. Still, faster collection of accounts receivables generally reduces the financing fee or the discount rate. The annual sales volume and invoice size will also affect the rate. This means that for few invoices that have yield large amounts, the factor offers better terms. Although having several invoices factored may lead to discounts, if the annual sales are small for each of these, then these may also be relatively more expensive than the earlier case. This is because more invoices to be factored means that the financing company will exhaust more resources and provide more services. There are other ways of determining overall fees, including the service or setup fees, historical dilution rate, and the length of relationship established between the client and its factoring company. All in all, it is best to know the particular process, privileges, and pricing methods of each prospective factor and then compare. iFinancing.ca is a private funding company allowing North American businesses to leverage their assets in order to obtain an improved and sustainable cash flow. Visit www.ifactoring.ca today to find out more information about asset-based financing.